Hello guys, welcome back. Let's move to our step number 5. Recognizes the revenue for each performance obligation as and when control is transferred. Now here the important thing is, let's link. On second step we identify the performance obligation. Step 3 we saw what is the overall total contract value. Step 4 we allocated the contract value to each performance obligation. So now we have a contract value allocated to each of the promises. Now IFRS 15 says you need to recognize the revenue as and when those promises get satisfied. Now that control can get satisfied either at a point in time or over a period of deal. Let's understand this. What is meant? For example, if I'm selling a mobile phone, I sold a product, I handed over to you, my control is transferred immediately. You become the owner of the phone once you pay me the consideration. But let's say I'm providing the support and maintenance services for next 6 months for the same mobile, and I'm charging you 5000 rupees extra. Now in that situation, my control gets transferred over a next 6 months, because customer can come back on third month as well, on sixth month as well. I need to serve him. So now standard says if any of the following three conditions are satisfied, then it is assumed that control is transferred over a period of time. Condition number 1: entity performs, customer receives simultaneous benefit. Or number 2: entity performs and it creates an asset which customer is controlling. Or number 3: the asset which is created by entity does not have any alternative use, and it has right to receive the payment in the event of termination up to the date of termination. Let's understand. First one says entity performs and customer consumes the benefit simultaneously. So for example, I am providing some services, let's say accounting services, for 12 months. By end of first month, I have done the first month accounting, I have submitted the reporting to a customer. Second month I have done the accounting, I have submitted the report to the customer. So here what is happening, my duration is 12 months, but by periodic basis I'm performing, and customer is also getting benefits out of that. So yes, services are provided over a period of time, control is transferred over a period of time. Or let's say second option, we are performing as an entity and it creates an asset, and which is controlled by a customer. For example, I am an IT company, I am developing a software, I have done the transition transformation, I am at development stage, so system is half prepared, but that is controlled by customer. It is there as a capital work in progress in its balance sheet. Or number 3, I am preparing something for which I don't have any alternate use, and if customer terminates, he has to pay me the penalty till the date of termination. Let's say same example, I am an IT company, I have done the transition, customer has terminated. Now what will I do with the transition work? I do not have any alternative use. If customer can, if customer is required to pay me the termination charges up to the date of work completed and terminated, yes, control is transferred over a period of time. If no, I will record termination, I will record transition at a control transferred at a point in time, not over a period of time. So three conditions: customer is consuming the benefits, customer controls the asset, no alternative use, and right to receive the payment up to the date of termination. Any of these three conditions are satisfied, your control is transferred over a period of time, your revenue will be recognized over a period of time. If all these three conditions are not satisfied, then control is transferred at a point in time and you will recognize the revenue as if control is transferred at a point of time. Full revenue in one time you will record. Okay, But let's say control is transferred over a period of time. How can you recognize the revenue? So again, again IFRS gives you a couple of options. One is an input method, one is an output method. What happens in output method? You recognize the revenue in the ratio of services delivered to the customer, which is a deliverable to a customer. For example, machine hours, surveys, actual cost to the customer. So these are the some options by which you can recognize the revenue. Input method, our cost of completed till date. For example, employee timesheet, hours planned versus hours consumed, straight line revenue if the efforts is going same. So revenue over a period of time can either be recorded by input method or by output method. Output method generally shows the factor which are outside the company's organization's control, like machine hours, surveys, feedback. Input method, it's generally more reliable because you use your own internal controls like employee cost, employee timesheet, efforts burnt, etc., and the revenue will get recognized accordingly. Now, how this revenue recognition entry works? So, what happens generally at the time of invoicing, your accounts receivable is debited to revenue credited. Now, you will see that performance obligation is satisfied or not. If not, you will move your revenue to your deferred revenue GL, or if it is advance money collected, you will move it to a contract liability GL account. And whenever the performance obligations get satisfied, you will use your balance sheet liability GL accounts to recognize the subsequent revenue. But let's say you have not billed to a customer and performance obligations are satisfied. In that situation, you are going to record unbilled revenue. So your entry will be unbilled receivable account debit to revenue credit. Unbilled receivable will stay in your balance sheet. Now these are very generic entries, and there are a lot of fundamentals and concepts like contract asset, contract liabilities, unbilled receivable. So basically, if I say that if your receivable is only portion left is a passage of time, then you can record it as a unbilled receivable. If it is depending on some other factor or some other performance obligation, you have to record that as a contract asset. If you have received an advance money from the customer, or you are supposed to, or that consideration is due in advance from the customer, you can record that in a contract liability account. So these are the some general definitions which needs to be assessed in detail while recording the journal entry of particular contract. You need to see case by case, so there is no standard approach to each revenue recognition entry. Now let's understand few other aspects of the IFRS 15 and some disclosure requirements. So number one, licensing revenue. For example, if I am giving something on license, how should I record? At a point in time, over a period of time, how? IFRS 15 clearly provides a guidelines that if a license is a functional IP or a static IP. What is functional IP? Functional IP means an IP which derives its fundamental functionality on its own. For example, Netflix, Amazon Prime. For example, I have built one content. Netflix has come to me and it has purchased the content for 3 years from me. Ownership is with me. I have just given a content to Netflix. In that situation, the IP is a functional IP because it has this standalone functionality to perform without my intervention. It is a content I have given on a lease. Now customer can use it for a certain number of years or a period. Control is transferred at a point of time. You will recognize revenue upfront. Let's see how at a point of time. I'm working, customer is benefiting simultaneously. No. Is it creating an asset which customer is controlling? No. Does it have an alternate use? Yes. If Amazon will not buy, I will sell it to a Geo or a Netflix. So all these three conditions are not satisfied, and hence you will record the at a point revenue. But let's say there is a static IP. Static IP means something which don't have its standalone functionality, or it requires my intervention for client to use. For example, logo, brand, trademark. It doesn't work itself. I need to give customer on license to use. For example, there is a one sports match. Let's say India Australia series is going to happen, and I have given one of the event company my logos to use. Now what will happen? I have given my functional, my static IP to be used for where revenue will get recognized over a period of time, because I can change my logo. I can direct customer how to use that particular logo. Customer will get benefited as I work, my brand name impacts. If I do some wrong work, my brand name will go down, it will impact the customer, and vice versa. So here revenue will get recognized over a period of time, and this is where US GAAP 606 has provided a detailed guidance that any brand, patent, trademark will get recognized straight line over a period of time, whereas the content, media assets, those kind of items will get recognized upfront. Now some disclosure requirements, very brief, again not conclusive or full. Just as a summary, you need to record the unsatisfied performance obligations. um, this is basically at performance obligation level, so how much revenue is still pending to be recorded in future, that needs to be disclosed. Unbilled receivable will go as a financial instrument on which ECL model or CECL model for US cap people will be applicable. You need to disclose the contract, significant judgments taken in recognizing the revenue for all those contracts. For US GAAP people, SSA reporting comes where you do the concentration risk, deferred revenue, contract liability movement, and the comparison of the bad debt movement where unbilled revenue gets impaired as well. That's a very brief, so this is the 5-step model of IFRS 15. If you have any questions, please let me know. Again, as stated earlier, this all 5-step model, it's just for education purpose, not to be taken as a judgment or a final decision call. Please reach out to your experts before taking a final call. Should you have any more questions, please reach out to me. I'll be happy if I can provide the relevant inputs to you. Thank you so much, guys. Have a nice day.